Hello friends. Welcome to Anhad channel, where we simplify difficult concepts in finance, banking, insurance, economics, and fintech. Today we are going to discuss a very important topic, financial crime and its prevention. With the rapid growth of digital banking, online payments, mobile wallets, and financial technology, financial crimes have also increased significantly. Understanding financial crimes is important not only for banks and financial institutions but also for businesses and ordinary citizens. In this session, we will learn what is financial crime, features and types of financial crimes, methods to check them like KYC, CDD, EDD, AML, transaction monitoring systems and suspicious activity reports, etc. Then we will also discuss the role of various regulatory bodies such as FATF and RBI, then role of technology like cybersecurity and AI-based fraud detection and mitigation of these frauds. So let us begin. First, let us learn what is financial crime. A financial crime refers to any illegal activity involving money, financial assets, financial institutions, or financial systems for personal gain. In simple words, whenever a person earns, transfers, hides, or uses money through illegal means, it is called a financial crime. Examples include fraud, money laundering, tax evasion, corruption, bribery, cybercrime, terrorist financing, and identity theft. Now let us discuss these in detail one by one. First is fraud, which refers to the intentional act of deceiving another person or organization for personal financial gain. In fraud, the offender uses false information, misrepresentation, forgery, or dishonest practices to obtain money, property, or benefits unlawfully. Examples include credit card fraud, which occurs when someone uses another person's credit card information without authorization to make purchases or withdraw money. It often involves stolen card details obtained through phishing, hacking, or card skimming. Insurance fraud involves providing false information or making fake claims to obtain insurance benefits unlawfully. It increases costs for insurance companies and honest policyholders. Loan fraud occurs when an individual or business obtains a loan by submitting false documents, fake identities, or misleading financial information. This can result in significant financial losses for lenders. Investment scams involve deceiving investors with false promises of high returns and low risks. Fraudsters often use fake investment schemes or Ponzi schemes to attract victims. Fake invoice fraud happens when fraudulent invoices are created and submitted to obtain unauthorized payments. Criminals may impersonate legitimate suppliers or create fictitious transactions to steal funds. Second kind of financial crime is money laundering. It is the process of converting illegally obtained money into seemingly legitimate money. Criminals attempt to hide the true source of funds generated through illegal activities such as drug trafficking, corruption, fraud, or terrorism. The process generally involves 3 stages. Placement is the first stage of money laundering, in which illegally obtained money is introduced into the financial system. Criminals may deposit cash into bank accounts, purchase financial instruments, or mix illegal funds with legitimate business income. The objective is to move the money away from its criminal source. This stage is considered the most vulnerable stage for detection by authorities. Layering is the second stage of money laundering, where multiple transactions are carried out to conceal the origin of the funds. Money may be transferred between different accounts, banks, businesses, or even countries. Complex financial transactions make it difficult for investigators to trace the source of the money. The main objective is to create confusion and break the audit trail. Integration is the final stage of money laundering, where the laundered money is reintroduced into the economy as apparently legitimate funds. The money may be invested in businesses, real estate, luxury assets, or financial investments. At this stage, the funds appear to have originated from lawful activities. Once integrated, the criminal can use the money freely with a lower risk of attracting suspicion. Let us understand with an example. A criminal deposits cash earned from illegal activities into various bank accounts and later invests it in businesses or real estate. Third kind of financial crime: tax evasion. It refers to the illegal practice of deliberately avoiding the payment of taxes that are legally due. It involves concealing income, overstating expenses, maintaining false records, or failing to report taxable income. Examples are not reporting business income, maintaining fake expense records, hiding foreign income, and using false invoices to reduce tax liability. Tax evasion is a punishable offense under tax laws. Corruption is fourth kind of financial crime. It is the abuse of entrusted power or authority for personal benefit. It occurs when individuals misuse their position to gain money, favors, or other advantages. Corruption undermines public trust and damages economic development. Examples are misuse of public funds, favoritism in awarding contracts, abuse of official authority, and embezzlement of government funds. Next, the fifth kind of financial crime is bribery. Bribery is the offering, giving, receiving, or soliciting of something valuable to influence the actions or decisions of another person. Bribery is one of the most common forms of corruption. Examples include paying money to obtain a government contract, offering gifts to influence business decisions, paying officials to bypass regulations, and receiving commissions for awarding contracts. Sixth kind of financial is crime: cybercrime. Cybercrime refers to criminal activities carried out using computers, digital devices, networks, or the internet. As financial services become increasingly digital, cybercrimes have become a major threat to financial institutions and customers. Examples include hacking. Hacking is the unauthorized access to a computer system, network, or digital device. Criminals use hacking to steal data, disrupt operations, or gain illegal financial benefits. Phishing attacks involve sending fake emails, messages, or websites to trick people into revealing sensitive information. The objective is usually to steal passwords, banking credentials, or personal details. Online banking fraud occurs when criminals gain unauthorized access to a customer's internet banking account. They may transfer funds, make payments, or steal financial information. Ransomware attacks involve malicious software that locks or encrypts a victim's data. The attacker then demands a ransom payment in exchange for restoring access to the data. Identity theft occurs when someone illegally obtains and uses another person's personal information. The stolen identity may be used to open accounts, obtain loans, or commit fraud. A data breach occurs when confidential or sensitive information is accessed, disclosed, or stolen without authorization. Such breaches can expose customer data, financial records, and personal information. Cybercriminals often target financial information and customer credentials. Terrorist financing is the seventh kind of financial crime. Terrorist financing refers to the collection, movement, or use of funds to support terrorist activities or organizations. The funds may originate from legal or illegal sources and are used to finance recruitment, training, weapons, logistics, and terrorist operations. Examples include donations sent to terrorist organizations, use of shell companies to transfer funds, illegal fundraising activities, and cross-border transfer of funds for terrorist purposes. Preventing terrorist financing is a major objective of AML regulations and FATF guidelines. Eighth kind of financial crime is identity theft. Identity theft occurs when someone illegally obtains and uses another person's personal or financial information without permission. The stolen information is often used to commit fraud or gain financial benefits. Examples are using someone else's Aadhaar number, opening bank accounts using stolen identity documents, applying for loans using another person's information, or unauthorized use of credit card details. Identity theft can result in significant financial losses and reputational damage to victims. These were 8 kinds of financial crime. Now let us discuss features of financial crimes. 1. Financial gain. The main objective is to obtain illegal financial benefits. 2. Concealment. Criminals often try to hide the source and ownership of funds. 3. Use of technology. Many financial crimes are now committed using digital platforms and online banking systems. 4. Complex transactions. Criminals frequently use multiple accounts and transactions to disguise illegal activities. Because of these financial crimes, financial institutions need protection. Banks and financial institutions handle enormous amounts of money every day. Without proper controls, criminals can misuse banking systems, illegal funds may enter the financial system and customers may lose trust. Also, financial stability may be affected. Therefore, financial institutions implement various preventive measures. Let us now discuss some important preventive measures to mitigate or lessen these financial crimes. The first and most important measure is KYC. KYC stands for Know Your Customer. It is the process through which banks and financial institutions verify the identity of their customers. The major objectives of KYC are to verify customer identity, to prevent money laundering, to prevent fraud, to identify high-risk customers, and to comply with regulatory requirements. KYC acts as the first line of defense against financial crimes. After KYC comes customer due diligence, commonly known as CDD. CDD involves collecting and verifying customer information to understand the nature and purpose of the customer's relationship with the institution. This includes identity verification, address verification, occupation verification, source of funds verification, and risk assessment. CDD helps institutions understand whether a customer presents low, medium, or high risk. Next is enhanced due diligence or EDD, which is one step higher than CDD. It involves conducting a deeper and more detailed investigation of customers who are identified as high risk due to their profile, business activities, geographical location, transaction patterns, or political exposure. This includes enhanced identity verification, detailed source of funds verification, source of wealth verification, verification of business activities and ownership structure, transaction pattern analysis, screening against sanctions, watchlists, and adverse media, identification of politically exposed persons and their associates, and ongoing and enhanced monitoring of customer transactions. EDD helps institutions gain a comprehensive understanding of high-risk customers, assess potential money laundering or terrorist financing risks, and ensure compliance with regulatory requirements. It provides greater assurance that the customer's activities are legitimate and enables institutions to apply appropriate risk mitigation measures. Next measure is AML or anti-money laundering plays a very important role in preventing financial crimes. AML consists of laws, regulations, policies, and procedures designed to prevent criminals from disguising illegally obtained funds as legitimate income. The objective of AML is to detect and prevent money laundering activities. AML regulations require institutions to verify customers, monitor transactions, identify suspicious activities, maintain records, report suspicious transactions. As a result, financial institutions can identify and stop illegal financial activities at an early stage. To identify suspicious activities, financial institutions use transaction monitoring systems. These systems continuously analyze customer transactions. They help detect large cash deposits, unusual transfers, frequent international transactions, sudden changes in transaction behavior, structuring and smurfing activities. Transaction monitoring acts as an early warning system against financial crime. When a suspicious transaction is identified, institutions may file a suspicious activity report, commonly called suspicious activity report. An suspicious activity report is submitted when a transaction appears unusual or potentially linked to criminal activities. Let us take an example of SAR. Suppose a customer normally deposits 40,000 rupee per month. Suddenly, the customer deposits 18 lakh rupees in cash over a few days. The transaction monitoring system flags the activity. The compliance officer reviews the transaction. If the explanation is unsatisfactory, a suspicious activity report is filed with the appropriate authority. This helps regulators investigate potential money laundering. Employee training is also very important in preventing financial crimes. Technology alone cannot prevent financial crimes. Employees play a crucial role. Regular employee training helps staff recognize suspicious behavior, detect fraud indicators, understand compliance requirements, and follow reporting procedures. Well-trained employees significantly strengthen fraud prevention efforts. For this purpose, organizations have whistleblower mechanism too. A whistleblower mechanism is a formal system established by an organization that allows employees, customers, vendors, or other stakeholders to report unethical, illegal, fraudulent, or suspicious activities without fear of retaliation. A whistleblower system allows employees to confidentially report unethical or illegal activities. Its benefits include early detection of fraud, improved transparency, better corporate governance, and reduced financial losses. Let us now discuss the role of cybersecurity in financial crime prevention. Today, many financial crimes occur online. Therefore, strong cybersecurity measures are essential. These measures include multi-factor authentication, encryption, firewalls, intrusion detection systems, secure passwords, and security audits. Cybersecurity protects both institutions and customers from online fraud. Artificial intelligence has become a powerful tool in combating financial crime. It can analyze millions of transactions, detect unusual patterns, identify anomalies, predict fraud risks, and reduce false alerts. As a result, fraud detection becomes faster and more accurate. Our last topic for today is the role of regulatory institutions in financial crime prevention. Financial crime prevention is a shared responsibility of various Indian and global financial institutions, regulators, and international organizations. Some Indian regulatory institutions inactive in the field of financial crime prevention are 1. Reserve Bank of India or the RBI. It regulates banks and payment systems. Issues KYC, AML, and CFT, combating financing of terrorism, guidelines. Monitors compliance with anti-financial crime regulations. 2. Financial Intelligence Unit, India, also called FIUNT. It receives and analyzes suspicious transaction reports, STRs. Shares intelligence with law enforcement agencies. Acts as India's central agency for combating money laundering. 3. Securities and Exchange Board of India or SEBI. It regulates the securities market. Prevents insider trading, market manipulation, and securities fraud. Enforces AML compliance among market intermediaries. 4. Insurance Regulatory and Development Authority of India. It regulates insurance companies. Ensures implementation of KYC and AML measures in the insurance sector. 5. Enforcement Directorate. It investigates money laundering cases under the Prevention of Money Laundering Act, PMLA, 2002. Attaches and confiscates proceeds of crime. 6. Central Bureau of Investigation, CBI, which investigates major financial frauds and corruption cases. 7. Economic Offences Wing, EOW, which investigates financial frauds, cyber frauds, and economic crimes. Some of the important global institutions working in this field are 1. Financial Action Task Force, FATF. It is global standard-setting body for AML and CFT. Issues FATF recommendations adopted worldwide. Maintains grey list and black list of countries. 2. International Monetary Fund, IMF. It assists countries in strengthening financial systems. Supports AML and anti-corruption initiatives. Now let us summarize today's session. We learned about the meaning of financial crime, features of financial crimes, types of financial crimes, KYC and customer due diligence, CDD, AML and FATF, regulatory bodies in India, role of RBI, banking frauds, transaction monitoring systems, suspicious activity reports, employee training, whistleblower mechanism, cybersecurity and AI-based fraud detection. Financial crime prevention requires a combination of people, technology, regulations, and ethical practices. Friends, with this we come to the end of today's session on financial crime and financial crime prevention. Thank you very much for watching this video. If you found this video useful, please like, share and subscribe to our channel. On this channel, we regularly upload educational content on economics, finance, banking, insurance, financial crime, GST, income tax, fintech, accounting, financial management, and investment management in a simple and easy to understand manner. Don't forget to press the bell icon so that you receive notifications whenever we upload a new video. Thank you for your support. See you in the next video with another interesting and informative topic. Till then, bye and take care.